Today, I'll be breaking down the critical tax changes for 2024 that you need to know. I know it's been hard for Canadians with tax changes, with inflation, with the stress of grocery bills going up and your mortgage payments going up. But there's light at the end of the tunnel with the latest updates for 2024. And for the most part, it's good news for Canadians who can expect lower taxes for next year. Whether you are a salary employee, juggling a family, running your own business, owning real estate, I have the latest changes for you. Hi, I'm Tracy. I'm a former engineer turned business owner and a part-time investor of a multi-million-dollar investment portfolio. The objective of these videos is to make you financially smarter every single day. In today's video, I'll be covering the following topics. For all Canadians, you're going to hear about the changes to the tax brackets, about your tax-free savings account, about your RRSP. Now, if you are an investor, I'll also talk about, I got you, Canadian dividend tax credit and capital gains. If you have children, I also got you. I'm going to talk about the changes to the Registered Education Savings Plan, the child care benefits. If you're looking to buy a home, you definitely want to hear about the home buyer's tax credit and the first home savings account and how they apply to you. If you own real estate or a business owner, you definitely want to hear about the changes to short-term rentals and GST changes. If you're looking to sell your business, you definitely want to hear about the changes to the lifetime capital gains exemption and the intergenerational transfers of your business. Let's talk about the tax brackets. The tax brackets are all stretching by 4.7% for all Canadians, which means we are paying less taxes. So for the lowest income tax bracket, where you pay only 15% of income taxes, is now $55,867, while the top bracket has also stretched by 4.7% accordingly, which is now $246,752, where you pay 33%. Now, those are federal tax bracket changes. Now, the provincial tax brackets have also changed accordingly. So in 2024, it is changed to now $51,446, while in the previous year, it was just under 50 grand. Now, if you want to see your provincial tax bracket changes combined with federal, go to taxtips.ca. I'm going to add the resource in my pinned comment below. Check it out. More good news. Now, let's talk about the basic personal amount, because that has also stretched. For those of you who don't know, the basic personal amount is simply the dollar amount that if your income falls below it, you don't pay taxes. So for 2024, the basic personal amount has grown to $15,705, as long as you make less than $173K. But if you make over than that, then your basic personal amount shrinks a little bit to $14,156. A quick tip. The basic personal amount could be transferred to the person with the higher income. How this works is, for example, you make $60,000 and your partner makes $10,000. That means that your partner makes a lot less than the basic personal amount. So the delta between the basic personal amount, which is $15,705, subtracted $10,000, is a delta of $5,705. That could be transferred to you because you're at the higher tax bracket. So you can use that extra moolah to reduce the amount of taxes that you pay. For capital gains, well, the first bracket has stretched to $55,867, and the lowest tax bracket for federal is 7.5%. Now, obviously, you just don't pay federal taxes. You actually have to add your own specific province to get the total capital gains rate. So let's look at, for example, Ontario. The first tax bracket is $51,446, and the capital gains tax rate, marginal tax rate, is 10%. So for example, if you sold some stock and you made a profit of $10,000, which is like amazing, and you made no other income, well, you would fall in the first tax bracket because it's under $51,446, which means you pay a marginal tax rate of 10%. So you would pay $1,000 in extra taxes that year. And if you were lucky enough to make over $246,752 in capital gains, you would pay a maximum 26.76% if you're living in Ontario. Now let's talk about Canadian dividends. So for Canadian dividends, there are eligible and ineligible dividends. Eligible dividends are simply dividends that you get from Canadian companies that are publicly traded in the stock market. And then there are ineligible dividends, which are typically dividends you collect from a private corporation. So for example, if you have a professional corporation and it pays you dividends, that's considered ineligible. So when we look at the split you could see up to the first 55,867 eligible dividends collect a negative 0.03% versus non-eligible dividends through a privately controlled corporation is 6.87%, which is very low. But this is the federal Canadian tax brackets. Now you got to add your own provincial tax brackets on top of it. So let's look at Ontario. You can collect up to $51,446 at eligible dividends, which is negative 6.86%. So literally it is tax free because there is a Canadian dividend tax credit. So what qualifies as eligible dividends? It's simply companies that are Canadian and distribute dividends through their company and they're publicly traded. So for example, banks, Canadian banks would qualify, power companies would qualify. As long as they're non-registered funds and if you collect $51,446 in Ontario, you could be paying $0 in taxes for eligible dividends, which is amazing. Now, where does this get cut off? So you could see that the max is 55,867. You pay a negative 1.2% for eligible dividends. The next bracket is 90,599, and you pay a little bit in taxes, which is 6.39%. Now, there's a caveat. You can't have any other sources of income if you want to use the full benefit of the Canadian dividend tax credit up to $55,867. So if you collect income from your pension, that shrinks your Canadian dividend tax credit. But if you collect incomes from tax-free sources like your tax-free savings account, well then that's a different story because that's tax-free. Now, if you jump to the highest tax bracket, which is $246,752, you could see that investment income always gets taxed way more efficiently than employment income. Your employment income gets taxed over 53% in marginal tax rates, which is like, boo. But let's talk about the registered account. The first one being the tax-free savings account. Literally, it's your piggy bank that grows over time if you invest in it. So with this tax-free savings account, as long as you're 18 and you have a social insurance number, you can open a TFSA right now. And the contribution room you have for 2024 is $7,000. Now, if you have been around in Canada for a very long time, you probably have a lot of contribution rooms. In order to check how much contribution room you have, go to CRA and look at your TFSA room. And if you haven't contributed since 2009, your total contribution room is now $95,000 in 2024. Now let's talk about the registered retirement savings plan, which is a piggy bank for your retirement or for other reasons like education fund or a house. Let's focus on the new contribution rooms. You are still maxed out at 18% of your income. Now, of course, if you make a ton of money, like $500,000, if not 18% of $500,000, it's capped at $31,560. And if you don't have $31,560, which is your maximum contribution room to contribute next year, it gets carried forward. Now, the cool thing about the RRSP is that the more you contribute in that 1 year, it can lower your tax bracket. So for example, if you make $70,000 and you contribute $10,000 into your RRSP, assuming you have enough contribution room, then you can lower your $70,000 income to $60,000. And that would be where you get taxed at, saving you money. So there's a caveat to the RRSP. Sure, it sounds good to get tax deductions in the year that you're working, but the assumption is that when you're retired, you're at a much lower income tax bracket so that the income you do withdraw from your RRSP, you get taxed on it at a lower rate. So just be mindful when you contribute to your RRSP. Ask yourself, will you be at a lower income tax bracket? Now, for the Canadians with children, let's talk about the child care benefit. For the 2024 year, families most in need can receive up to $7,437 per child under the age of 6 and up to $6,275 per child between the ages of 6 through 17. This represents an increase of 6.3%. Of course, you got to be eligible and you will know after you file your taxes. There's also changes to the registered education savings plan. Now, there's no changes to how much you can contribute. Unfortunately, you can only contribute up to $50,000 of money to help pay for your kids' education costs, but you still get free grant money from the government. So anytime you have a kid, you definitely want to open this account. But what's changed is how much you can withdraw from the account. So when your child is able to go to university, now in the initial weeks of school, you can withdraw way more money. And these are called EAPs, Education Assistant Payments. So right now you can withdraw up to $8,000 of EAPs in the initial weeks of your kids going to school full time. If your kid is going to school only part-time, then they can withdraw up to $4,000. Now, this is a big change because it used to be $5,000 and $2,500 respectively. Here's how much you can withdraw: maximum of $28,122 of EAP in 2024, which is a big change from 2023, which was only $26,860. The next one is the Climate Action Incentive Payment. If you live in certain provinces, you could be collecting these paychecks to help you offset the rising gas bills and fuel costs. So if you are in Alberta, Manitoba, Ontario, Saskatchewan, Newfoundland, Nova Scotia, and PEI, we're going to be expecting some paychecks. And this is based on per person, per kid, and you get paid out 4 times a year. Now, if you're looking to buy your first home, I got you. There's a lot of tax incentives. The first one is the First Home Savings Account, which is literally a savings account for first-time home buyers. Now, as long as you haven't owned a home in the last 4 years, you can open an FHSA. As long as you're not entitled, you can open an FHSA and you can contribute up to $8,000. And over 5 years, the maximum contribution rate is $40,000. That means in the future, you could withdraw $40,000 from your FHSA to use towards your first home. And the best part, the money you put in your FHSA acts as a tax credit and reduces your tax bracket. It's like a hybrid between the TFSA and the RRSP. So for example, you make $60,000, you contribute $8,000 into your FHSA. That $8,000 immediately reduces your income to $52,000. Let's talk about the home buyer's tax credit. If you're looking to purchase a home, you and your spouse can get up to $10,000 of tax credit, potentially saving you up to $1,500 in 2024. All you need to do is file your tax return and in line 31720, put in $10,000 and could potentially save up to $1,500 in credits. Just remember, when you file your income tax return on line 31270, enter the amount $10,000. Now, for business owners and real estate investors, there are also tax changes. So the first one is the disallowed short-term rental deductions. All that means is that if you're operating an Airbnb or short-term rental unit in a city that makes it illegal, or you don't have the right licenses for it, because like, for example, in Vancouver, I think you have to pull a permit or a license to rent out your basement unit on Airbnb. And if you don't have it, you can't write off all the expenses. There's been, unfortunately, case studies in Montreal where a woman rented out her unit and didn't get the right permit or didn't get the right license, and unfortunately couldn't write off all of her expenses related to cleaning, to operating the Airbnb as business. For real estate investors, there's a substantial change to GST. If you're looking to build 4 units or more, you can get your GST 100% back. This change is to help reduce costs for builders because we're in a huge housing shortage. Let's talk about the intergenerational transfer. Super important for business owners who are looking to transfer their business to their loved ones. So in the past, before 2024 was really complicated. Now they've simplified the process. You can transfer your business lump sum to your loved ones or over a 10-year period. Why 10-year period? Because then you can reduce the amount of capital gains you pay over the years, assuming, of course, your business is profitable. Next one is the lifetime capital gains exemption. So if you're looking to sell your business, in the past, it was $971,190, but in 2024, you can have a lifetime capital gains exemption of $1,016,836 in 2024. So for example, if your business was worth $1 million and you're looking to sell it, well, you could potentially pay $0 in taxes because the capital gains tax exemption is over $1 million in 2024. Now, if you want to build $1,000 in passive income per month and become financially rich in the future, check out this video here. Anyways, I hope to see you in the next video. Bye.